Hello everyone, this is Organic Trader. So I'm remaking this summary video because I watched the previous one and it was not up to the mark. I couldn't deliver what I know. So I'm remaking it. So let's start with the basics again. What is an order block? An order block is an area of inefficiency or institutional buying and selling from where price gets impulsive movement. So first of all, a myth you need to eliminate or eradicate is that order block is not associated with the color of the candle. So, for example, if no normally what smart money traders do, they mark the different color candle in for an order block. For example, if there is a bearish momentum right here, like this, from this candle downwards, like this, they will mark this candle as an order block like this uh, supply zone. So they will mark this candle as their order block. So the myth you need to eradicate is that order block candle does not have a color. Why? So I will explain it. Look, now we are in a downtrend like this. We are in a downtrend and this is the high that we create. And then we again move down. Okay. Now we cannot, if the structure is like this, now you cannot consider this candle as an order block zone because this bearish candle sweep the liquidity of this bullish candle. Now your order block zone will be this one. This red candle will be your order block. So you need to eradicate this myth that order block candle has a color. Now I will show you some chart examples and make things much more clear for you. So this was the chart I was using, USD JPY, and this was the example that I gave. Now, what mostly traders do, they mark the last selling candle and consider from where price has sudden movement and consider that as an order block. For example, they will mark this candle as an order block, which is totally wrong because this candle's liquidity was swept by this third candle. First, second, and third. So you cannot mark this as an order block zone. And if you see on the right hand side, price didn't even tap into this zone. So this is not an order block. So one thing for an order block candle does not have a color. It can be bullish or bearish. Second thing, order block candle must sweep away liquidity of the previous candle. So this is your point number two. Order block candle does not have a color and order block candle must sweep away liquidity of the previous candle. Now, there must be proper imbalance after the order block candle. So I'm telling you the confirmations. So this is point number three. Here we have our fair value gap. When you go to lower time frame, you can refine this zone. Okay. And then we need to have break of structure. Right here, we have a break of structure on the lower side. And then we move up and this is our ChoCh. Don't worry, I will explain break of structure and ChoCh right after this. I'm coming to that. So what we look 4 to 5 points while marking order blocks. Now point number one, candle must sweep liquidity of the previous candle or order block candle must sweep away liquidity of the previous candle. There must be imbalance, inefficiency after the order block candle, which is a fair value gap. The fair value gap is in three candle movement. Like this is from the top of the first candle to the lower wick of the third candle. That is your fair value gap. Where fair value gap is basically an imbalance. So these are the 2 points. Point number three, we must have break of structure. So if you look on the left hand side, we are in a downtrend right here. Let me show you like this. We are going down, making new highs and going down, taking them out. And here we have this break of structure. Let me mark it for you. This is our break of structure. This is our break of structure. This is our break of structure. So this is also our external break of structure as well. This one, if I extend it right here, external break of structure. Okay, and this is our choke. So if these things happen, that order block candle becomes a high probability. So as I've said before, order blocks at swing highs and swing lows are high probability. Now I have said the order block candle sweep away liquidity of the previous candle. There must be imbalance. There must be break of structure. And the most important thing, there must be time confluence. So we are looking at the 1 hour chart. We'll move to 30-minute. 30-minute, we have this candle which was our order block candle. This 30-minute candle sweep away liquidity, same break of structure, same choke, and our fair value gap zone is reduced to this. Now you can stick to 1 hour and 30-minute to mark your zones, or you can go down to refine it even more. Now our fair value gap is reduced to this zone. Now if you go to 5-minute, zone will shrink more. But I would suggest you to stick to 1 hour and 30-minute. Right here, this becomes your, uh, I would suggest you to go to 5-minute, it will get a lot tricky. So stick to 1 hour, 30-minute, 15-minute, don't go lower than that while marking your zones. When we need to enter, we will even go to 1 minute time frame. Okay, so this is our order block zones, fair value gap. Now let's talk about break of structure. Now we are in a bullish trend. So we make higher highs, higher lows, higher highs, higher lows, and we break the previous structures right here, like this. This is our break of structure. Now, what is choke? A choke is simple break of the last higher low. So if price comes down, breaks this higher low and closes below this becomes our choke. A choke is an indication that trend is reversing. So just like I show you this example right here, we had a choke on the 30-minute and 1 hour. This was our choke. So this was an indication that price was reversing, and when price came back to our order block zone, we executed right here and take profit right here. Okay, this was in bullish scenario, and if I invert this chart, there's no invert option. Okay, I will show you. Now this will be your break of structure on the lower side. This on bearish momentum, this becomes your break of structure, and if price breaks above this last higher low, higher high, this is your higher high, and this becomes your choke. So this is your break of structure and choke, and I do hope it is clear. I will show it on 1 minute time frame as well while explaining entry in this video right here. Now I will tell you about fair value gap. What is a fair value gap? Let's say these are three candles. Fair value gap will always be an the form of three candles. Okay. Now, the zone between the upper wick of the first candle and lower wick of the third candle is called a fair value gap, like this. Fair value gap is an imbalance and it is a confirmation to the order block. Why it is an imbalance? Because there is so much orders being placed right here that price don't come down and creates an inefficiency or imbalance in the market. So it gives a further point of clarification or a confirmation to your order block zone or your supply and demand zones. I would do like to hear feedback from you as this is first time me explaining concepts which I have learned after watching countless videos. So do tell me what I can do to improve my explaining. Now let me give you another example of a sell order block right here. Now look in this scenario, a bearish candle and a bullish candle. Now in this scenario you can mark a bullish candle as an or a supply zone or a order block zone. Why? Because look at this bearish candle. This bearish candle did not sweep away liquidity of the previous bullish candle. So the bullish candle is your order block zone. Now you extend it and look. In Asian, price went up. In London, price tapped this order block zone and went down. And in New York, we got the chance of executing buys from the order block of the Asian session. I will explain this concept of accumulation, manipulation, and distribution in upcoming videos. So this was break of I have done with break of structure, chalk, order blocks, fair value gaps. Now let's talk about breaker blocks. I explained that too in a video. What are breaker blocks? For example, if here is an order block, we mark this as an order block. Okay. Now consider price doesn't reverses from this zone and price goes down and closes below this area. Now once price has closed below this area, this does not remain an order block. This becomes a breaker block because price didn't respected this area. Now how you can plan your entry or how you can look at it differently uh, in such a way that you can find a trade. You will wait for price to tap back into this zone, into this breaker block like this, and then you can go for sells. This is how breaker block works. So when a breaker block is simply a failed order block. So that's what I would like to explain. I missed some of the points in my first order block video. So that's what I wanted to explain. Now, just if you can work on refining your zones or getting better at marking accurate zones, SMC is way easier than any other strategy. I have traded SRC for 2 years and I've been doing SMC pretty recently. So SMC is far superior to SRC. Smarter the concept does win trades is simple candle anatomy, but SMC is superior. Trust me, it is coming from a funded trader. I passed my challenges with SRC. I traded live accounts with SRC, but once I saw SMC, I shifted. Okay, this was the thing I wanted to explain, which I couldn't cover in the last 4 videos, and I will upload this video as a summary. Again, maybe I replace the previous video, uploaded it. I will replace the previous video, it wasn't that good. So explain those things which I couldn't explain in the previous video, and I will upload it. Next video will be about premium and discount zones. So stay tuned for that.